Hey everyone, welcome back to Corporate Decoder, the place where we dissect the confusing world of corporate filings. Today we're diving into a report from Insulet Corporation. It looks like they've been busy juggling debt and making deals. Let's see if they stick the landing or if this is a recipe for a financial faceplant. Insulet just released a report called an 8K. Companies put out these reports to tell investors about big, important changes that could affect the company. This one is about some new debt they took on and how they're managing some old debt. It sounds boring, but it could mean a lot for the company's future. This report is dated March 21, 2025. That means these events just happened recently. So what exactly did Insulet do? First, they made a big agreement about some debt they issued, which means created and sold $450 million worth of senior notes. Think of these notes like fancy IOUs that the company has to pay back with interest. These notes have a 640% interest rate. That's the percentage Insulet has to pay on top of the borrowed money each year. They don't have to pay it all back until 2033. So this is a long-term loan. There's also a trustee involved, Computershare Trust Company. A trustee is like a middleman who makes sure Insulet follows the rules of the agreement and protects the people who bought the notes. These notes are guaranteed by Insulet's subsidiaries, which are companies that Insulet owns and controls. So if Insulet can't pay, these subsidiaries might have to step in. As of the date of this report, there aren't any companies actually guaranteeing the payment. Next up, Insulet changed an existing credit agreement, which is basically a contract for borrowing money. This is the 7th time they've changed this agreement, so they've been tweaking it for a while. The main thing they did was extend the deadline for when they have to pay back some of their debt. They moved it from 2028 to 2030. That gives them more time to come up with the money. They also increased the amount of money they can borrow under this agreement to $500 million. This is called a revolving credit facility. It's like a credit card for companies. They can borrow money of this money. As of the date of the report, they hadn't borrowed any of this money. They can use this borrowed money for working capital, which is the money they need to run the day-to-day operations of the business and for other general corporate purposes, which is a fancy way of saying they can use it for pretty much anything. The interest rate on this credit facility depends on a few things, but it's based on something called the term SOFR rate. That's a benchmark interest rate that banks use to lend money to each other. The interest rate also depends on how much debt Insulet has compared to its earnings, or as the report calls it, adjusted total leverage ratio. There's also a financial rule that Insulet has to follow. It's called a leverage ratio. This ratio basically says how much debt Insulet can have compared to its earnings. If they have too much debt, they could be in trouble with their lenders. Finally, Insulet also made some agreements to unwind or undo some previous transactions called capped call transactions. These transactions were related to some convertible senior notes, which are a type of debt that can be converted into stock. Insulet bought back some of these convertible notes from investors. This means they paid investors to take back the note. In connection with buying back the notes, Insulet undid some of those capped call transactions. It's a bit complicated, but basically it involves some financial institutions or companies that were betting on Insulet's stock price going up. All of this activity creates financial obligations for Insulet. They have to pay back the notes, they have to follow the rules of the credit agreement, and they have to manage the unwind agreement. This section is a disclosure that tells us about the note repurchase transactions. Insulet bought back $419 million worth of its convertible senior notes. They're doing this in 2 stages. Some of the deals close quickly, but the rest will happen in mid-April. The price they pay for the second batch of notes will depend on the average price of Insulet stock over a certain period. After all of this, Insulet will still have about $381 million worth of these convertible notes outstanding. The investors who sold their notes back to Insulet might also be doing some trading of Insulet stock. This is because they were using financial tools called hedges to protect themselves from the risk of the stock price going down. Now that they've sold the notes, they don't need those hedges anymore, so they're unwinding them. This is where the actual documents that make up the agreement are listed. For example, the indenture, which is the official agreement for the notes, is listed as an exhibit. So is the 7th Amendment to the credit agreement and the form of unwind agreement. Now let's zoom out and look at what all this means for Insulet. It seems they're trying to manage their debt by taking on new debt and extending the deadlines for paying back old debt. This could be a good thing if they can use the extra time and money to grow their business and become more profitable. But it could also be a risky move if they can't generate enough cash to pay back all that debt. One thing that stands out is the interest rate on the new notes, 650%. That's a pretty high interest rate, which means investors see some risk in lending money to Insulet. That could be because Insulet is spending a lot of money. The fact that they are using the revolving credit agreement is interesting. That shows that they have access to more funding in case of any emergency. Overall, Insulet seems to be navigating a complex financial situation. They're taking on new debt to manage old debt, and they're tweaking their credit agreements to give themselves more time. The big question is whether they can execute their business strategy and generate enough cash to pay back all that debt and keep growing. If they can, they could be in a good position for the future. If not, they could face some financials. Then thanks for watching, and remember to like, comment and subscribe for more corporate decoding.